The harsh truth about trading, why most traders keep losing. If you've been in the Forex market for any length of time, you've probably asked yourself this painful question, why do I keep losing no matter how hard I try? It's not because you're not smart enough, it's not because you don't spend enough time studying charts, and it's definitely not because you don't work hard. The real reason lies in one brutal truth. If you don't have a trading edge, every trade you take is no better than flipping a coin. Flipping the coin experiment. Imagine this. You take a coin, flip it into the air, and let it fall. Heads or tails. 50-50. Pure chance. Now open a random Forex chart. You are USD, GBP, JPY. Doesn't matter which one. Don't analyze. Don't overthink. Don't add any indicators. Just place a trade buy or sell completely at random. Next, set your stop loss and take profit at a 1-1 ratio. If you risk $100, you aim to make $100. If you lose $100. Now repeat this experiment 100 times. No emotions, no adjustments, no chasing losses, just random trading exactly like flipping a coin. What happens? At the end of those 100 trades, you'll probably end up with something like this: 50 wins, 50 losses, maybe 48 wins and 52 losses. Pretty much break even. But here's the catch. After accounting for spreads and commissions, you're slightly negative. Your account is lower than where it started, even though you didn't make any emotional mistakes. This is the brutal reminder: without an edge, trading is gambling. Why most traders fail. So why do most traders consistently lose money? Because they spend years learning strategies, indicators, and secret setups without ever understanding the one thing that matters: probability. They think trading is about predicting where the market will go. But the truth is this: the market doesn't reward prediction, it rewards probability management. If you don't manage probabilities, you're just spinning a roulette wheel in the casino of Forex. And guess what? The casino, the market always wins against gamblers. Understanding probability in trading. Let's go back to the experiment. We said a 50% win rate with 1-1 risk reward leaves you break even at best. But here's where things get interesting. What if you keep the win rate at just 40%, but you adjust your risk to reward ratio to 1-2 or 1-3? That means if you lose $100. But if you win, you make 200 or 300. Now let's run the math. Out of 10 trades, you win 4 trades and lose 6. You make $800 on the wins and lose $600 on the losses.
End result plus 200.
You're profitable even though you lost more trades than you won. This is the first shift you must understand. Trading is not about being right, it's about managing risk and reward. Why this changes everything. Think about it. How many times have you beaten yourself up because you got the direction wrong? How many times have you abandoned a strategy because it didn't give you a high win rate? Here's the truth: you don't need to win most of your trades to make money. You just need to structure your trades so that your winners are bigger than your losers. That's it. This is where real trading begins. And it's also where most traders fail because their focus is in the wrong place. They're obsessed with finding the perfect entry system, the magic indicator, the secret guru signal. But none of that matters if your risk to reward ratio is broken. A new way of looking at trading. So here's the mental shift I want you to make today. Stop thinking of trading as a game of predictions. Start thinking of it as a game of probability. When you flip a coin, you know the odds are 50-50. But if you can set up your trades so that every win pays twice or 3 times as much as every loss, suddenly the odds bend in your favor. This is the difference between a gambler and a trader. The gambler places random bets hoping to be right. The trader structures risk so that even being wrong more often still produces profit. And this brings us to the most important question: how do you consistently find trades with that kind of edge? That's what we'll dive into next. But before we move forward, I want you to pause and ask yourself honestly, are you currently trading with an edge, or are you just flipping coins with indicators attached? If that question makes you uncomfortable, that's a good thing. Because awareness is the first step toward change. Why most traders fail even when they work hard. By now you've seen how simple probability can expose the truth about trading. If you treat the market like a coin toss, you will always hover around break even or worse once fees and commissions are factored in. And yet every single day, millions of traders are burning hours, staring at charts, reading countless strategies, and still wondering why their accounts keep shrinking. The problem is not lack of effort. The problem is effort misdirected. The illusion of hard work in trading. Many traders believe that the harder they work, the more charts they analyze, the more indicators they stack onto their screens, the more successful they will be. But trading is not like school or a corporate job where extra effort alone produces better results. In fact, in trading, more effort often leads to worse results because it feeds emotional impulses. Think about this. How many times have you caught yourself redrawing trend lines, switching time frames, adding new indicators just to make sense of a trade you were already biased about? That's not analysis, that's rationalization. And it's one of the most dangerous habits in trading. You see, effort without direction is noise, and in trading, noise destroys accounts. The real skill behind trading. So if effort and intelligence aren't enough, what is the real skill that separates profitable traders from losing ones? It's the ability to stick to a system that has a positive expectancy and to let probability do its job. Positive expectancy means that over a large sample size, your system generates more profits than losses. It doesn't mean every trade wins. It doesn't even mean most trades win. It means that when you follow the system consistently, the numbers tilt in your favor over time. This is the hardest pill for most traders to swallow. Why? Because it requires patience and discipline, two traits that go directly against human psychology. Humans are wired for instant gratification. We want to feel good now, so when a trade goes red for just a few minutes, we panic and cut it too early. Or when a trade finally goes green, we grab profits quickly, afraid they might disappear. Ironically, this destroys the exact edge that could have made the system profitable in the long run, the trap of emotional trading. Let's be honest, most of us don't lose money because our strategy is fundamentally broken. We lose money because we don't stick to it. Picture this. You've tested your strategy, you know the rules, you promised yourself you'd follow them no matter what. Then the market opens. The first trade goes against you slightly. Fear kicks in. You close early only to watch the market reverse and hit what would have been your full profit target. Frustration builds. The next time you refuse to close a losing trade, convincing yourself it will come back. It doesn't. The loss grows bigger. Suddenly you've broken the rules twice in a row and your system looks useless. What do you do next? You start hunting for a new system, you binge watch YouTube videos, you buy another trading course, you join another signal group, and the cycle repeats. This is why the majority of traders never succeed, not because they didn't have a potentially good system, but because they couldn't trust themselves to follow it. Discipline over prediction. Here's the truth. Trading has less to do with predicting the next candle and more to do with controlling yourself while those candles form. Every trader has experienced this paradox. The market seems easiest when you're backtesting or demo trading, but suddenly impossible when you're live with real money. That's because when money is at risk, emotions hijack your brain. Greed, fear, frustration, and overconfidence cloud your decisions. So the number one skill you must master is not reading charts better, it's mastering your own mind. Discipline means following your rules, even when every cell in your body screams at you to break them. It means sitting on your hands during sideways markets. It means taking losses quickly and without hesitation. And most importantly, it means trusting the process even through losing streaks because you know your edge will pay off over a large sample size. How to build true consistency. So how do you actually build this discipline? You don't just wake up one day with it. You build it through repetition and reflection. One of the most effective tools is a trading journal. Not just to record your entries and exits, but to record your emotions. Write down exactly why you entered, how you felt during the trade, and why you exited. Over time, patterns will emerge. You'll see that your biggest losses didn't come from the system, they came from your emotions. Another powerful method is to simplify. Many traders fail because they juggle too many systems, pairs, and timeframes. Pick one currency pair, pick one time frame, pick one setup, then master it. Trade it until you know its rhythm as well as you know your own heartbeat. Consistency comes not from knowing everything about the market, but from knowing yourself within the market. The myth of the perfect system. There is another dangerous illusion in trading, the belief that somewhere out there is a perfect system that wins almost every time. Traders waste years chasing it, but here's the reality: no such system exists. Every strategy has losing streaks. Every edge comes with drawdowns. The goal is not to find perfection. The goal is to find a system with positive expectancy and then align your mindset so you can stick with it long enough for the probabilities to play out. This is why professional traders don't obsess over the next trade. They focus on the next 100 trades. They know any single outcome is meaningless. What matters is the law of large numbers. Redefining success in trading. At this point, you might be realizing something profound. Success in trading is not about working harder, knowing more, or predicting better. Success in trading is about becoming the type of person who can execute a simple plan with ruthless consistency. So ask yourself, do I really have a system with an edge? Am I following it exactly, or am I sabotaging myself with emotions? Am I measuring my success by the outcome of one trade or by the consistency of 100 trades? These are the questions that separate gamblers from traders. And this brings us to the next crucial concept. How do you actually create and validate a real trading edge? Because without that, all the discipline in the world won't save you. That's exactly what we'll uncover in the next part. Building a real edge in trading. At this stage, you understand two crucial truths. First, trading without an edge is no better than flipping a coin. Second, success doesn't come from predicting better or working harder. It comes from discipline and consistency in following a system with positive expectancy. But now comes the most important question of all. How do you actually create a real edge in trading? Because without it, no amount of discipline will save you. What is a trading edge? A trading edge is simply this: a repeatable process that, when executed consistently, produces a statistical advantage in your favor over a large number of trades. It doesn't mean you'll win every trade. It doesn't even mean you'll win most trades. But it does mean that over time the math tilts toward profitability. Think of it like running a casino. The house doesn't win every hand of blackjack. Sometimes players hit a lucky streak. But the casino always has a mathematical edge. Over thousands of hands, that edge guarantees profitability. In trading, you must become the house. Step 1. Testing and validating. The first step to building an edge is rigorous testing. Too many traders jump into live markets after spotting a few perfect setups on a chart. That's not enough. You need to backtest your system on at least 200, 300 trades. Record the exact entry rules, exit rules, win rate, average win, average loss, and risk to reward ratio. From this data, calculate your expectancy. The formula is simple: expectancy equals win rates, average win, loss rates, average loss. If the result is positive, congratulations, you have a potential edge. If it's negative, no matter how good the setups look, the system won't make money in the long run. Step 2. Specialization. Another common mistake is spreading yourself too thin. Many traders try to trade every pair, every time frame, every strategy. This creates confusion and inconsistency. Instead, specialize. Pick 1 or 2 currency pairs. Pick 1 time frame, pick 1 setup. Study it until you know it inside out. The more you specialize, the more nuances you notice. You'll see how your chosen pair reacts to news, how it respects support and resistance, and how momentum shifts at different times of day. This deep familiarity becomes part of your edge. Step 3. Psychology and execution. Even the best edge is useless if you can't execute it. So this is where psychology comes in. The market will test your patience with losing streaks, false breakouts, and long periods of sideways action. If you abandon your system at the first sign of struggle, your edge dies. This is why journaling and mindfulness are so important. By documenting not just your trades, but also your emotions, you can identify patterns of self-sabotage. Over time, you'll learn to separate your identity from individual trade outcomes. You're not your wins or losses, you're the executioner of a system with probabilities on its side, the 3 pillars of a true edge. So what does a sustainable edge really look like? It rests on 3 pillars. Statistical proof: your system has been tested and shows positive expectancy over hundreds of trades. Market understanding: you've specialized in one area of the market and understand its behavior intimately. Psychological discipline: you have the mindset to stick with the system through both winning and losing streaks. Remove any one of these pillars and the edge collapses. Keep all 3, and you have the foundation of long-term success. The story of a consistent trader. Let me share a story. I once met a trader who wasn't particularly brilliant. He didn't have fancy indicators or complex models. He wasn't glued to his screen all day, but he had something rare: consistency. For 3 years straight, he traded only 1 pair on 1 time frame. His win rate was just 35%. Most people would scoff at that. But here's the catch: his average win was 3 times larger than his average loss. That meant even though he lost most of the time, his account grew steadily month after month. How did he do it? By mastering the 3 pillars. He tested his setup thoroughly, he specialized in one market, and he had the discipline to stick with it even when he faced strings of losses. His edge wasn't magic, it was math focus and patience. Redefining your relationship with the market. Here's a mindset shift that could change everything. Stop seeing the market as something to beat. See it as something to partner with. The market doesn't care about you, it doesn't know you exist. But if you align yourself with its probabilities, it will reward you over time. That means letting go of ego. Too many traders blow accounts because they take losses personally, as if the market is attacking them. Losses are not failures, they're business expenses. Just as a shopkeeper pays rent, traders pay losses. The goal is to keep expenses small and revenues larger. Practical steps to sharpen your edge. If you're wondering where to start, here are actionable steps. Backtest your current strategy over at least 200 trades. Forward test it on a demo account before going live. Track every trade in a journal with screenshots and emotional notes. Focus on 1 pair until you know its patterns like clockwork. Define clear risk rules. Never risk more than 1 to 2% of your account per trade. Review weekly to identify mistakes and adjust. Do this consistently and you will gradually carve out an edge. The long game. At the end of the day, trading is not about getting rich quick. It's about survival first, then growth. Your first goal is not to double your account. It's to stay in the game long enough for your edge to pay off. Remember, the market is a place where the impatient give money to the patient. If you can adopt this mindset, then every losing trade becomes just another step toward long-term profitability. Final thoughts. We've come full circle. From the coin toss experiment that exposed the futility of random trading to the discipline required to follow a system to finally building a true edge that can withstand the test of time. The journey isn't glamorous. It's not about perfect entries or secret indicators. It's about boring repetition, statistical edges, and unshakable discipline. But within that boring repetition lies freedom, the freedom to grow your account steadily, and the freedom to control your own financial destiny. So I'll leave you with this question. Are you ready to stop gambling and start trading like the house? The choice is yours.